Hello and welcome to the Weekly Outlook at XM.com. Next week will be a crucial one for central banks as they will be making the final rate-setting decisions of this year. In addition, there will be a great deal of economic data coming out, which may be important for the US dollar, the euro, and the pound. I'm Maria Pachurdes, and with me to unpack all this is lead investment analyst Rafi Boyadjian. So Rafi, the Fed's last meeting of the year will conclude on Wednesday, and markets are hoping for signals of a dovish pivot of some sort. How likely is this? And what about the upcoming data, including the November CPI report on Tuesday and November retail sales on Thursday? Do you think these figures will shed light on whether the US economy is entering a recession?
Well, Maria, I think the Fed has made its intentions pretty clear. We had quite a lot of speakers ahead of the blackout period, all coming out and saying pretty much the same thing, that there's still some way to go in terms of rate increases. The only pivot that we're going to get right now is the one which we already got, which Powell himself confirmed this when he last spoke days before the blackout period. So basically, it's almost certain that the Fed will slow down the rate of increases. We had 4 meetings of 75 basis point rate hikes. Now it's time to go ahead with 50 basis point rate increases. So that's pretty much a certainty. I guess the bigger question mark is surrounding the dot plot and what the Fed's terminal rate is going to be, as opposed to what markets are pricing in right now. And a number of Fed policymakers have pointed to a terminal rate of at least 5%, or between 5 and 5.25% range. We should really expect this as the minimum, but looking at the futures markets, right now the terminal rate has fallen to around 4.9%. So clearly there is scope for a positive surprise, a hawkish surprise from the meeting. And more importantly, if we have a look at the market reaction to Powell's last comments, which they interpreted Powell as being somewhat less hawkish, and which clearly wasn't the case, but this is how markets interpreted things. That suggests that Powell might try to reiterate clearly the message that the job is not done in terms of rate increases. There's still some way to go. They're not going to be cutting rates anytime soon. So he may try to ratchet up his hawkish rhetoric in his press conference. And should he succeed, we could see bond yields jumping again, because we saw quite a substantial drop in treasury yields over the last month or so, particularly in long-dated yields. And should we see the Fed trying to reverse this, we could see bond yields shooting higher and the dollar also following yields higher as well.
Okay, moving over to Europe now, there seems to be signs of a split amongst ECB Governing Council members regarding the size of the next rate hike set to be delivered on Thursday. Do you think they're likely to hike by 50 or 75 basis points? And what reaction might we see in the euro?
So there does appear to be some split within the Governing Council. Markets are betting on 75 basis points. Economists, on the other hand, think the ECB will raise rates by just 50 basis points. There is, of course, growing concern about a recession in the euro area, and the ECB has yet to actually put this in its forecast. We may get that on Thursday. We're going to have the latest macroeconomic projections by ECB staff being published, and they could put in there a recession for 2023, or at least 1 quarter of negative growth. And should that be the case, that could be taken as, that could be quite negative for the euro. And also there's a danger that Lagarde might signal that the inflation is peaking, has started to peak in the eurozone. On the other hand, maybe again there's a risk that some investors have misinterpreted some of the comments. In fact, a few officials have been a lot more hawkish, and we also had a survey recently of inflation expectations, consumer inflation expectations in the euro area heading higher. So ECB might decide to make another 75 basis point rate hike for now and then leave it for next year before slowing down again. But for the euro, even if we do get a hawkish surprise, I think a lot will also depend on what the Fed will do. So that's also going to be quite important as to whether or not the euro will be able to stretch its current rebound.
Now, another central bank that might slow rate hikes is the Swiss National Bank. At its last meeting in September, it raised rates by 75 basis points. Is the SNB done with big rate increases, or do you think it could still surprise? And how might the franc be affected?
Well, I don't think they're done with rate increases just yet, but clearly there is less urgency for the SNB compared to other central banks. Inflation appears to have settled around 3%, which is that's a lot lower than what we have in other countries, particularly the UK and Euro area, where inflation has hit double digits, around 10 or 11%. So the SNB can afford to go slower. But on the other hand, they only meet 4 times a year, and there's still fairly substantial upside risks to inflation. So they might try to play it safe and go with 50 basis points and then slow down at the next meeting, which is in March. So because of that, because they only meet 4 times a year, I think it's more likely they will go with 50 rather than 25. But as far as the Swiss franc is concerned, even if we do get a dovish surprise from the SNB, I think there's still kind of, because of the uncertainties around the outlook for next year, there's still a fair bit of safe haven demand, and so that should keep the franc supported in the next few months at least.
Finally, over in the UK, although the Bank of England will meet on Thursday, the spotlight will probably be on all the data coming out, starting with monthly GDP figures on Monday, the latest labor market report on Tuesday, inflation stats on Wednesday, and retail sales and flash PMIs on Friday. What will all this data mean for the pound?
Well, indeed, it's a jam-packed week for UK data, and so the Bank of England might turn out to be a non-event because we're not expecting any surprises there. They will probably raise rates by 50 basis points. So although this would be a smaller increment than the 75 basis point we got last time, markets still see quite a lot of rate hikes ahead for the Bank of England. In fact, the BoE probably has the most rate hikes yet to deliver, even though the bank's own forecasts suggest that the bank rate will peak a lot lower than what markets are implying. But we're not going to get any new forecasts in December. That's going to be a story for the February meeting next year. We might get some clues from the bank's statement about the pace of rate increases going forward. On the whole, though, I don't think the Bank of England will be as important for the pound as the other central banks will be for the other currencies. I think the data will probably matter a bit more. And again, we're not going to likely not going to have anything too market moving, but overall, given the pessimism we have around the pound, the UK economy at the moment, should we see overall stronger than expected numbers coming in, particularly from the jobs data, the GDP data, and the flash PMIs, that could boost sterling, especially if we see the dollar sliding on the back of the Fed. Now, the inflation data, of course, it will be the most important one, but I think that might not have a huge impact just yet because markets want to see how inflation is going to pan out in the coming months and whether or not it has peaked or not. So I think it's going to be the overall picture we're going to get from the data that's going to matter for the pound.
Rafi, thanks so much. And thanks for joining us at XM.com for this weekly outlook.